We start today's market talk. Markets aren't driven purely by logic, but by the stories we tell and believe. When these narratives become divorced from reality, bubbles form. Successful investors don't try to predict crashes or time the market perfectly. They build robust processes that work across market conditions. More importantly, having emotional discipline to stick to your strategy when everyone else is either euphoric or panicking is the critical part. While others chase hype, the real wealth is built quietly. Now, the market outlook, as I see it, there are four key factors which are working in the market. First is free trade is a strategy, just like protectionism, appropriate to a certain stage of economic development of a country. Hence, why is the US now going in for protectionism? The most important conflict in the world today is a conflict between US and China over preeminence in the world economy. Also, China's increasing technological sophistication and fear that it will challenge the US in technology is another issue. So, Z is posing as a champion of globalization as Chinese firms are competing with US on every front, and while the US is now looking to kick away free trade and embrace industrial policy and tariffs once again. Now, for India, retail inflation data for November brings much needed relief. So, will we see a rate cut at the next MPC meeting in February? Inflation fell from 6.2 to 5.5%. Food inflation fell from 10.9 to 9% year on year. But core inflation, excluding food fuel, was 3.87 compared to 3.85. So, is muted core inflation an indication of low demand? IIP data was weak, and the bank's credit growth was is also declining. So, by February, union budget will be out of the way, fiscal deficit will be cut, Trump and his disruptive policy would be known, and Fed would have cut another 25 basis points. So, probability of rate cut in India in February is pretty high. The stock market took investors on a wild ride to close this week in India, while next week's US Federal Reserve policy will be critical. Now, the US jobs data left people believing that the Fed will cut rates, but consumer sentiment is highest and year ahead inflation expectations have picked up. November's CPI slowdown showed an increase which was higher than expected. This makes things unpredictable. Other aspect of US unpredictability is what Trump might say or do because he is likely to keep the world on its toes by his activities. The other point is the China really ready to stimulate the economy or it is still unpredictable? Because trade figures are weak with slump in imports, that means their domestic consumption is falling. Annual economic planning conference called for proactive fiscal policy as well as increasing deficit and issuing more ultra long bonds next year. Also, lower interest rates. Now, the point is, all these news is there for the last 3 months, and markets have reacted number of times to this news. Now, this time, the metals didn't react positively because normally what happens is that the metals always react to Chinese stimulus, but this time they didn't react positively because probably the market is not sure about these promises and looking for more action on ground. Now, coming to the US, if you see as I've discussed about US inflation data, while CPI inflation data was in line, but the producers' price index readings were higher than anticipated. So, market participants, though, are certain that Fed will deliver a 25 basis point rate cut next week. But if you see the bond yields are not talking about that. Bond yields were up around 6% last week. So, which indicates that people are not expecting a rate cut as such. Now, the US dollar index again rose and rose around 1% last week. So, after the decline which took place when it went to 108 level. Now it is again going back. So if it may go up to this 109, 110 level also. Brent crude rose around 4% last week based on likely possible sanctions on Russian oil by the US. So this was one of the reasons for the oil to bounce back, but nothing great. It has to cross this declining trend line on the way upwards, and it otherwise it is weak because the expectations of demand for crude is weak. Now the gold, which was reversing, had bounced, then it again has corrected, and we'll have to see this rising trend line whether the it takes support here or not. So if it breaks this support, then it will go down and may test the 50-day moving average. Copper also didn't go up; it corrected from the 50 EMA. So right now the expectations of economic recovery in China and rest of the world are not that much. Hence the copper prices are also not moving. Bitcoin rose and it recovered and it went up to 100,000 dollars plus, $100,000 plus level. So right now the trajectory is up. It went around 0.6% last week. So it is constantly on an upward trajectory. Nasdaq made a high and was up around 0.73% based on good momentum with AI related stock, while Dow corrected around 1.82% and even S&P also corrected. This is actually year-end profit taking because the markets have run up a lot. The trajectory is still up. So there's nothing much to get really worried about. India VIX is on a declining trajectory, and though it went up on Friday, but it came down very quickly and now has come down to 13 level. And in right now, because of not much of a event risk as such, so it is expected to go down. But now it is moving as per the movement in the uh, Nifty as such. Now, Indian government bond yield is on also is on a lower trajectory, and now it came and tested that this declining trend line. So once there will be more certainty on rate cuts in India, then this bond yield is expected to go down further. Now, Nifty as such made on a weekly chart, made a weekly hammer. It is above the 20 EMA and the trajectory is upwards. So right now the momentum is positive and it is recovering or from the lows it had made at around 23, 300 odd levels. On the daily charts, it has made a inverted head and shoulder. So the logical technical targets for this inverted head and shoulder should be from this baseline of around 24 to 24 300 odd levels should be around 25 400 odd to 25 500. So we may see, and this is from where the Nifty bounced also on Friday also. It corrected up to this baseline of the inverted head and shoulder and then bounced from there. So this should provide a decent support. And right now, if it trades above the high it made on Friday, it should be positive. So it has to go above the Friday's high. Similarly, this move has to become a trend upward move because right now there is not much of momentum last week which was seen. Market breadth has to also improve, and then market has to respond to positive news or any negative news. Right now, it was not moving, and FI flows will also determine the direction of the market. Though at end of the year, FI flows also become muted, so not much is expected out of them. Uh, Coming to hourly chart, so after the moment on Thursday last week, the big moment which took place on Thursday last week, then the Nifty was kind of range bound over the complete last week till the time it became energetic on Friday. It dipped and then bounced back from there and made Nifty nearly made a 600 point moment. It had become oversold in the morning, and there from there then the buying came. So right now I will have to watch this trend as such. Nifty Bank, it is struggling with this breakout attempt. So it has to go above this 54,000 level for some momentum to emerge. But it is strong because it is above the 20 EMA, and it also made a weekly bullish hammer pattern. On a daily chart, it was going down, but then it bounced very quickly above the 20 EMA on the daily time frame. And also the 20 EMA is trending upward. So it is in momentum. Now it is not very far from its all-time high at around 54,500 level. So this is the level to watch out over the next week. And if other banks perform along with HDFC Bank, this should go up. Now, HDFC Bank is the one which is holding the market up, and it recovered from the lows it made to below 1840 and then quickly bounced back to 1880 level. So we'll have to watch this. If it goes up, it'll take the Nifty Bank and the Nifty up. Reliance has been weak, and it tested that 200 EMA on the weekly charts. So this week low of 1239, these levels have to be watched. So if this level break, then it will go down to that 1100 odd levels, the last lows it had made. Nifty Midcap was on an upward trajectory, but kind of stagnated last week. So it had dipped, but then it recovered at end of the day. So we'll have to watch this. So if these mid caps and small caps perform, then the overall market breadth improves. Similarly, as I told you about small caps also, it was on a rising trajectory and nearly made a fresh all-time high, but then has corrected from there. So if it trades above this 20 EMA and makes a fresh high from here, then it should be positive. Now I'll cover three stocks. First is Jeena Sikho Lifecare. Incorporated in 2017 by Mr. Manish Grover, properly known as Acharya Manish Ji, it is one of India's leading Ayurvedic healthcare companies. It is well placed to tap the healthy growth opportunities in Ayurveda, Yoga, and naturopathy, Unani, Siddha, and homeopathy Ayush by rapidly expanding its network of clinics and hospitals. Expect a revenue EBITDA PAT CAGR of 34%, 40%, and 41% over FY24-27. So this is good. 30% revenue growth and 40% profit growth, driven by rise in bed capacities, higher occupancy in core hospitals on the back of CGHS, SGHS enrollments, and greater footfalls of insurance-bearing patients. It is eyeing acquisitions of O2C products and is working towards developing Ayurvedic formulations for critical diseases. It expanded its services footprint by 250 beds in H1 FY25, taking its total bed capacity to 1530. It plans to add 500 beds by March end, taking its total bed additions to FY25 to 750. Management is targeting a total bed capacity of 5,000 beds from more than 2,000 beds in FY25 in the medium term, positioning itself for significant growth. It expects an improvement in occupancy rates greater than 50% in H1 FY25 for mature hospitals, though new bed additions may limit the rise in occupancy on a consolidated basis. Its R&D division is working on Ayurvedic formulations which may emerge as an effective substitute for allopathy, blood pressure drugs, and infertility-related treatments. It saw IPD volumes grow to 12,000 in H1 FY25, over 90% of FY24 footfalls. OPD volume grew to 1.58 lakh patients in H1 FY25. The management sees higher volumes with the inclusion of Ayurvedic treatments under the list of therapies approved for medical insurance. So this CGHS, medical insurance, hospitals and the basic interest in Ayurveda should be a big provide momentum to this stock. It clocked medicine order volumes at 2.2 lakh in H1 25 as against 2.09 lakh in FY24, with average revenue per occupied bed grew to 8,100 as compared to 7,900 to rupees 6,100 in FY24 FY23. Its doctor count has risen to 4,450 doctors in FY25 from 300 or 230 in 24-23. Focus is on improving occupancy in existing hospitals, setting up hospitals, and scaling up product sales through organic and inorganic means. Seeing their quarterly result, they actually come up with half yearly result because of their size. Right now, the revenues are on upward trajectory and increasing every 6 months. Operating margins are also now at the higher level, and net profit is also improved and is growing now. And EPS is now at the highest, around 18 rupees for first half of the year, 18 or 19 rupees. So keep that in mind. So, seeing that growth trajectory, they should do around 30 to 40% CAGR growth, and the operating expenses are coming down as the operating leverage plays into comes into play, and operating margins are improving, and net profit margins are operating improving. So, revenues are, as we discussed, are expected to grow on 30%, and profit is expected to grow on 40 to 50% over the next 3 years. So, keeping that in mind, they should do around 40-45 EPS in FY25 and around 60 to 70 over FY26-27. So, keep that in mind. ROE, ROC, etc. are improving. They are good cash flow position, so hardly any debt. Year-on-year strong growth in EPS and EV/EBITDA is declining. Now, this stock is a very strong chart and has always traded above the and moved along the 20 EMA. It has become overbought in the last few days on very high volumes. So now it is declining, but somewhere close to this uh, the 20 EMA is should be a good level to enter this stock and hold this stock, because if you see 60-70 rupees EPS in FY26, means the stock is roughly forward P is around 30 odd, which is decent. Next stock is Interarch Building Products. It is one of the India's leading turnkey pre-engineered steel construction solution providers with integrated facilities for design and engineering, manufacturing and on-site project management capabilities for installation and erection of pre-engineered steel buildings. The pre-engineered steel building PESB industry in India is valued at 20,000 crore, with organized, unorganized players contributing 45%, 55% in terms of revenue and capacity. It ranks among the top two in India's organized market, commanding a market share of 7 to 8% in total industry revenue. Interarch and Kuwait-based Kirby Building Systems compete for large and complex projects. In the low value and simpler project segment, it faces competition from firms like Everest Industries and Pinar Industries, which are 50% of Interarch's size in the PESP segment. The industry is projected to double its size over the next 3 to 4 years, with organized players growing at faster rate than unorganized counterparts. Complex and large-scale projects have seen significant traction due to increasing demand from sectors such as semiconductors, data centers, renewable energy plants, and electric vehicle manufacturing. It caters to diverse range of industries, including automotive, FMCG warehouses, quick commerce, cell manufacturing, solar, semiconductors, EVs, renewables, and others. This diversified customer base positions it well to secure complex and large order bids. Production capacity is around 160,000 metric ton per annum. It is undertaking a capex of 70 crore to set up two new plants by FY26, which will increase its capacity by 40,000 tons, bringing it to around 2 lakh tons. The management plans to double capacity over the next 4 years. That means they are seeing the demand. Order book stands at rupees 1300 crore and is expected to be delivered within 9 months. Of this, rupees 900 crore are projects in industrial and manufacturing sector. 40% are projects linked to the electric vehicles and renewable energy industry, which are the one where there is a growth. The balance is from logistics and other industries. Management expects 16 to 18% volume growth in FY25. However, revenue growth may be lower due to declining steel price. So, sustainable volume growth is projected around 12 to 15% over the next 3 to 4 years. So that means there is a sustainable growth in volumes and earnings will take place. It operates on an efficient working capital cycle of just 22 days, aided by vendor credit, customer advances, and an optimized inventory management. Now, seeing their quarterly results, Again, year on year, there is a decent around 10% to 15% growth in uh, revenues. Though the last quarter is their strongest quarter, margins are at steady around 8, 9, 10%, and net profit is also improving, and EPS is also going up. So they have done around 26 rupees, 26 and a half rupees EPS till in the first half. And last year they did around same 51, 52. So as the last quarter is the largest, so they should do north of around 55 EPS in FY25 and maybe around 60, 65 in uh, FY26. And margins, etc., are constant. Operating expenses are generally at around 90%. So, as their volumes increase, their efficiency will improve. Their ROE, ROC are in 20% range. Debt is not there, good working capital cycle. So, as we have discussed, they are likely to do around 60 plus uh, earnings in FY26. So, keeping that in mind, this listed at around 900 and with increasing capacity, etc., at around 60 plus EPS with steady growth uh, at around these levels, at around 1600 level, this is a good buy. So it moved up quickly on Friday, but with large volume. So every dip should be a buying opportunity closer to 1500 levels. Last stop today is Office Space Solutions. Office is a pan-India flexible workspace solution provider which operates in two segments: rental, design, and build (D&B) services that contribute 73 and 25% of the total revenue. In rental, it has an operational inventory of 1 lakh 10,000 odd seats across 180 centers in 18 cities. So it is in all large cities of the country. In design and build service, it provides fit out services to clients in IT, BFSI, and telecom sector and boasts of an order book of 175 crore. Around 73% of the operational inventory is occupied with an average monthly seat rate of 9,000 rupees. 66% of seats are rented under the managed aggregation model, where on a case to case basis, 40 to 90% of the fit out capex is borne by the landlord. So their capex requirement goes down. It shares 70% of the operating profit with the landlord under managed aggregation model. Its balance seats are rented out under straight lease, where capex and occupancy risk is borne by them. Seats higher under the MA model carry an EBITDA margin of 22% and 95% occupancy. However, ROC is twice in straight lease as landlords share capex with office under the MA model. It achieves uh, operating break-even at 40 to 65% occupancy under the MASL model. Steady state occupancy at a mature center is 85%. Blended occupancy, however, stands at 73% on sharp inventory additions. Given the gradual increase in share of mature center, it expects a steady improvement in blended occupancy. Expect it to comfortably reach 1,35,000 operation seats by FY25, and from there it may expand its market share by adding 30,000 to 40,000 seats annually to capture the growing demand. The design and build segment will deliver sustainable growth on market share gains. Uh, for external clients, it carry an EBITDA margin of 18 to 20%, led by 29% CAGR in seat inventory, an annual 6% growth in average seat rate, steady occupancy of 73%, a 50% revenue CAGR in the design and build segment on strong demand. Expect 40% revenue CAGR over FY24-27. EBITDA is set to grow at 74% CAGR over FY24-27 on a strong revenue growth, operating leverage benefits, and better product mix. Now, if you see their quarterly revenues, they are on a constant upward trajectory. Though expenses are also going up, but the operating margins are on rise. Now they're reaching around 34%, and net profit is increasing. They had become profitable last year, and now because of the operating leverage, the profits are increasing. So they would do around 5.5 EPS in just one quarter in September. So now, with the increase in revenues and income from operations, they are expected to do around 1,800 odd crore in FY26 and 2,300 crore in FY27. So they should do a profit of 70 crore in FY25 and double that profit, and then double over next 2 3 years. So this is on a really good upward trajectory, and same with EPS also. In my opinion, easily they should do in FY26 at this rate around 20 rupees or maybe higher. And we'll have to watch their performance, but they can easily increase their EPS even at this rate at around 5 to 6, 7 rupees every quarter. So operating expenses are declining as part of the total net revenues, and EBITDA margins are improving, and profit margins are also improving. They are expected to do around 30-40% of revenue growth over the next 3 years, and EBITDA and EPS growth is nearly doubling every year now. ROE is improving as the business become more matured, and EPS, as we've discussed, in my opinion, they should do around uh, 30 or 35 between FY26-27. So right now it should be trading at around 20-30 P for forward P for 26 as such, and EV EBITDA is declining. Now see their chart, it listed somewhere in June. Then it went up to 900 plus. Then it corrected because of news of some stake sale. And now it has come down to this level where volumes are higher. So every dip here, somewhere closer to this 700 or 680, should be a opportunity to get this stock. I finished. We will take questions now.